We will now get into the source of our trading style. You now learned different trading strategies around the daily profiles and the openings in a daily volume profile or volume session and the value area, and we will now create some or explain you the technical deviation. Because in trading we should always try to simplify things, and we did this with a TTT blueprint, we call it. So what is the TTT blueprint, or what are the technical deviations? They're kind of a combination of market and volume profile, so it's a very simple version, but you can use them as a setup. You just need a raw candlestick, like on the right side. You just need a raw candlestick chart, that's it. You don't need volume, you don't need market profile, you don't need anything, just a raw Japanese candlestick chart is enough. You can choose your individual time period depending on the time horizon you want to trade on. With this approach you can determine trend structures or ranges based on closing prices of that Japanese candle. So officially you would just need the closing prices of those candles, but of course it's better to have some more information. That's why we take Japanese candlesticks. We will use PB and D structures to classify the market, either if we are in an uptrend, downtrend, if we have long continuation and strength in an uptrend, or if we have short covering, so short positions getting closed, or if we have long liquidations, depending on if a P or B is appearing in an uptrend or in downtrend. We will create reaction levels based on the analysis, so where do we look for trades, where do we enter, where do we put our stop losses, and we will find the appropriate setups for the appropriate time frames, and we will take into account the money management, but there will be a whole series about that topic itself. So the derivation of boxes based on the volume profile and kind of market profile is, well, let's first define our end goal. Our end goal is that we create boxes like you can see in purple here. That we create boxes like this, and those boxes should be orientated or kind of the same as the mountains in the volume profile. So you can see a mountain here, and when we don't have the volume profile and we only use a candlestick chart, our question is how can we get as close to the volume profile without having the volume profile? But we use those as setups. So our goal is to create boxes. And the very basic, or the most basic logic of this is that we count the closing prices. So we have one closing price here at the green candle. We have a bullish candle, we have an uptrend, we had one range here, we have an uptrend. Then we have one lower close, which is down there. We have another close, which is down there. So we could draw our first resistance line here. Then we have a breakout above this resistance line. But compared to this resistance line, we have one upper close and another upper close. So those two closes are above this line. So we have one support line on the bottom. We have one resistance line on the top. But we had a breakout, then a back break in, and again a breakout. And at some point we will have again two lower closes, so the other two lower closes. So this is our highest close, or this is our highest close from the first one, and then at some point we have another close above, but the close above is this one. No, it's not this one because it's a bearish candle. We had a small gap up, but the close was inside or below the previous resistance line. And then we have another breakout, and another breakout is here. So we have another close up here. So we can take another box and create it over here. So this is our resistance line. So our goal in the end is to count closing prices. We'll go to that in detail with some examples in the following slides, and then to create boxes. And those boxes are or can be our support and resistance line. We can trade break into the boxes. So we look for a pullback on the upper box, or we enter market as a reversal because we are in an uptrend here, and we can trade break-ins. We can also, there's one of the best setups, we have a box because we have a resistance line, we have a support line created here. This is our first range of the box. Then the box or the range of the box was extended here. Then we break out to the downside. Sorry, this is the third extension of the box. We break out to the downside, and then we break back into the box because we have another close inside the box here, and then we try to trade long. Either we go in market or we wait for a limit on the low box for a continuation trade. This does not always happen, but those are the different setups that we use and we try to implement in trading, and we are able to use them on any chart. We just need a raw candlestick chart. Of course, the same, there's a bullish box. There can also be bearish boxes. So you have the volume profile. As you can see, there is the mountain of the volume profile. We have a really balanced profile, and we can always count the closes and then create those boxes. But I think it's more easy if we go through them in detail on the next slides. So we have P patterns that can appear in an uptrend like here. We have a strong push, likely that we're gonna have single prints or strong buyers here or a news event, and then we create a range. So we have a P profile. The same we have with the B profile. In this case, the P profile is in kind of an uptrend and the B profile is kind of in a downtrend, but those can also happen. A B can happen, we have an uptrend, and it also can happen that there is a B created. So there is acceptance down, and then we create a B. As you can see, this is the B profile. In this case, this can also happen. We will go through examples later on that. So we also have these. These are more or less just ranges. You can also use them, you can also trade them, but I think the more interesting setups and the one we go more in detail are the P's and B's. But there are also these setups. These setups are just the same logic applies. So if you have two lower closes, you can draw your resistance line. If you have two upper closes, it's kind of small here, but at some point in here, I think there are the first two upper closes. Then we have a continuation. Here we have one, two more upper closes, so we can draw a support line here, and then we have our range. So this is our resistance line, this is our support line, and here we can look for breakouts with dynamic setups. It's in the following series, series 600, where we talk about order book footprint, volume, and things you can add on smaller time frame to find setups and to define or check the markets if there's a breakout in this time, or you trade back the break in if there was one, or you just play the balance price. So you search for longs down there and for shorts up there, or you wait if you want a more safe setup that we break out and then we break back in. Same on the downside. You can of course check for longs here, but very often the market takes out the previous support in this case, and then you wait for the break in, and then you check for a long price or a long entry here market, or you will wait for another retest and then long. But this is for the next slides. So this is the cheat sheet. You can make a copy, whatever, but you should realize and understand these patterns. You should study them deeply. We have different rankings, so we have kind of a good ranking. So we make a happy smiley, another happy smiley, a smiley that is not as happy, and we have a sad smiley. But all those setups are still usable. It doesn't mean just because the smiley is sad. It's just to remember maybe the different validity of the setups more. So if we have an uptrend, or in general we have a P shape, so we have a strong push, and then we have one, two lower closes if we would have in candles. So there's one lower close, two lower closes, and this one is the highest close of the bullish candle. Then we can start to draw a resistance line. At some point we will have two higher closes or upper closes. At this point on the lowest close we will draw our support line. So in this case it is around here, it's just a model. And if we break out below this lowest closing price after two higher closing prices have happened, and then we have our first range of support, which is this range here. So this is our balanced profile. This is the accepted price of the market participants. Price has spent there some volume and some time. And then if we break out to the downside and we break back in and we have a closing price in the range, that is perfect setup for trend continuation. So very often we have an uptrend and then a P occurs, and then we have this setup. So we have a resistance line, we have a support line, we have a box created, a balance created, and then we have a breakout or fake out to the downside. We don't want to trade this because it would be against the trend and kind of aggressive. And then we have a break in. We can look for market entries and put our stop loss either below the candle, depending on how big the candle is, or the stop loss below the impulse move, but depending on the risk to reward you have, and always in the relation to the take profit. So where's your take profit? Your take profit to the upside. Your first take profit can always be, or partial exit could be, the resistance of the box, but it is very likely that this ones get taken out. And we continue, so you can scale in with stop buys or another retest on the upside, and your take profit will be depending on either naked POCs or value areas or the overlay of a couple of important levels of the past. So if there is for example, several value areas overlaying in one area and there is a POC, maybe this can already take profit, and then we have a very good risk to reward depending on where we put our stop. But it's always an intercorrelation. There's no 100% fixed rule, but at first you can always remember you can put your stop loss below the candle that did the break in and then continue to trade long. So this is the first example. In the second example, we don't have that fake out. So the fake out down here is missing. There is no fake out. We just build a balance. Again, we have 1, 2 lower closes. We have 2 upper closes. We have a resistance line as soon as we have 2 lower closes. As soon as we have 2 upper closes, we also have a support line. And at some point we will break out to the upside. So we will have a candle that closes outside of that range, depending on the time frame you choose. But in this example, on a 5-minute time frame, we have a breakout. Then we can go or scale in market, or we wait for a retest, depending on the speed of the market and your trading style, how aggressive you are. If you rather take more setups, less setups, you need to adapt it for yourself and what works for you. Both is possible. Also, it depends on how big this breakout candle is. If the breakout candle is very big, it can be good to get or could be good to wait for a retest, because otherwise the risk to reward is too bad, depending on where you take profit or area of interest of the past is. But this is the second setup. We don't have the breakout. We have an aggressive continuation, and here usually we wait for the retest, and then you can use the stop loss. Let's choose red for the stop loss. You can put the stop loss below that candle or below a high volume area. So you can either have a volume profile, but in this example, I mean, the main goal is to only use candlesticks, but it's very likely that most of you will add a footprint chart or order flow to put it below high volume area and footprint, but the basic rule is to put the stop loss below the breakout candle. Take profit, again, depending on the past important or in levels of interest. The third one is a reversal. So those 2 patterns are continuation patterns. The third one is a reversal pattern. And in this reversal pattern, we have a breakout like this. So maybe we already tried a long trade here, but we failed. Maybe we scaled in here aggressively and we failed. And then we have our resistance line. Again, we had 2 lower closes of the candles and 2 upper closes. With the 2 lower closes, we have our resistance line. With the 2 upper closes, we will go through a chart example. In the next step, we have our support line. We have a breakout. Maybe we scaled in, maybe we didn't scale in. Maybe we got a trade, maybe we didn't. Doesn't matter, but stop losses are part of the game. Very important to remember. So, and at some point we will have a break in. So we have a candle opening outside of the box, but closing inside the box. Then our goal, or we can go in market here or wait for a pullback and then short to at least to the other side, but as it can be a reversal depending on the context where it disappears. For example, if you have a balance area where you have a D profile or a balance shape profile, and this happens on the upside and you have a breakout and a break in, then maybe you can hold your trade more aggressive and it is more likely that we will continue to the downside. You always need to put in context where your take profits are. But this is the first reversal sign, so you entry as you have a close back into the range. The last example is the one with the bad smiley, but still a very good usable setup. We have an impulse. We have two lower closes, so we have a resistance line. We have two upper closes, so we have a support line. And at some point we will break out to the downside. But this break-in is missing, so there is no break-in to the range. We only continue downwards, and it would be too aggressive for us to just scale and limit here. Of course we could do that, but it's not the setup we prefer, and it's not the setup we want to teach. Our setup is we then created a low, and if we bounce back from our resistance of the box, of the balanced box, we can enter with a close, or with the first candle that closes below the low of the fake out to the downside. And then our goal is, or take profit at least, is there will be some start of an impulse. So the impulse will have started somewhere, and in this case, then this is our first goal. Again, there can be also interesting levels, for example, naked POCs from the past or value areas, so we can trade further there, but very often it takes out the start of the impulse of the P-shape. Let us now go through some examples. So there are some screenshots of charts. So at first, we had the abstract example, but we will now go through some examples. So at first, we will look for two lower closes. So of course we have two lower closes here, but there's no real history, so let us start at this point. So we have an upper close, we have one lower close, another upper close, so there's no resistance line. Another upper close, upper, higher, 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 and we have one lower close. But still no second lower close, because this one again is a higher close. Another higher close. Now we have one lower close, and another lower close. So at this point, when this candle closes, we can start to put our resistance line over there. Now we will check for two upper closes. So we have one higher close, another lower close, another lower close. Now we have one higher close and another higher close. So this is the lowest close after we have two higher closes. So now we have our range area, high volume area, whatever you want to call it. But we have kind of a P-shape because we are an uptrend, and then we created balance. For us, this is no balance because it's only one lower close. So in this case, what are the setups we have? We have an aggressive continuation in this case because this close is above our resistance line. So either we can scale in and open the trade here. Let me switch to green. So either we can buy market here, or we can wait for a pullback on the support line and scale in here. And our stop loss is below the breakout candle. So our stop loss is below here. You can also look deeper into the candle, search for a high volume area, but this is part of another series. In this basic setup, you put your stop loss below the breakout candle. Hope you understand this example. Otherwise, always ask questions. To take profit, depending on historic values, maybe there's a naked POC, maybe there's a valley area, or there is a mountain, so a POC or a valley. Let us go through the next example. So again, we ask ourselves, where are the first two lower closes? So we have higher, 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 one lower close and another lower close, because this close is lower than this close on this high. So we have our first resistance line. Then we will check for where are the two higher, or the first two higher closes. So we have one higher close and we have kind of another higher close. So this could be the first support line. Then we have a breakout to the downside. So this is a breakout, but we don't trade it because we have a P shape. And as I said, in a P shape, just to trade the breakout to the downside, too risky that setup. We wait for a break in. And at this time, we have a break in. So we have a couple of examples here. So either we had a breakout, now we have a break in, so we can buy market here or wait for a pullback on our support line. So we will most likely buy somewhere here and put the stop loss below the break-in candle. So this is the break-in setup that we have in this case, stop loss below there. Furthermore, we have another example. So because we also have a breakout, let's assume that this price level is on the same price level and the breakout is this doji candle. Kind of a weak signal, but still is a breakout because we have a close above our resistance line. So we could scale in market here and put our the second setup. So this one is the first setup, and here we would have a second setup. So we could buy here and then we put our stop loss below there. In this case, we would have been stopped out here, and that is totally fine. Again, stop losses are part of the trading game, but this would be the trade of the continuation setup. So let us check if there are more examples in this case. We have another lower close, but it's not really a break-in. We have continuation, so we have one higher close, another higher close, and here we have two lower closes. So again, we can draw our resistance line over here, and over that resistance line we have a breakout with this candle. And with this candle we could enter market here, but if you look at the relation between, if we would put our stop loss below the breakout candle, because that's what the rule is, and we enter there, our risk to reward is kind of bad. So in this case, it is more likely that we don't enter market there. We would wait for a pullback, but this pullback is not there, so maybe we would not get a fill. But this is the example that first, there are stop losses. Second, there are different types of entering a P-shape. Third, there will be examples where you will not find an entry because it's about the relation between the breakout candle or the break-in candle, and in general the context where this appears. So, and in all of those cases, our take profits, you can choose a fixed risk to reward, but it's not what we teach, but a lot of people prefer it. But we look for interesting levels from the past. So is there a mountain, or is there a valley, or just an interesting area in the past, which will be our take profit. All those examples we just went through, we have for the bearish scenarios. So it is the same. In this case, we need two upper closes. And when we have two upper closes, in this case, we can draw our resistance line. When we have two lower closes, we can draw the resistance line. The first line in this example is the support. If we have a break-in, it's the same scenario. Either we can enter a market or we wait for a pullback and continue downwards. So we have our entry over there. So we enter at the close or we enter at the pullback, and we put our stop loss above this candle, and then we look for trade continuation. So our plan is that the trade will continue in this direction, and we can scale in at the breakout. We can wait for a pullback depending on, again, the context of the market. But this is the setups that can trigger your entry. Same is for the breakout without the fake out to the upside. So we just have a continuation trade. Again, we put our stop loss above the breakout candle in this case. We can enter market aggressive or wait for a pullback. With the reversal scenario, so those are continuation patterns because we have B's, then we continue in the same direction. Here, and we have B's, we continue in that direction, and here we have B's, but we trade to the opposite side. So the aggressive one will be, we have a fake out. Maybe we have this setup and we tried to short at this price level, and then we get a break in. And in this case, we can enter market or wait for a pullback, and again put our stop loss below the break-in candle and look for a continuation at least to the other upside or to the other side of the range, and depending on how much speed, for example, there is, or acceptance and volume there is, we can look for a continuation, but we should take partial profits over there. And in the last example, we have a fake out, and then we fail with the break-in. It's our preferred scenario, but this one fails, we don't get a break-in, and we just bounce again back. And then if we have a close above the highest point of the fake out to the upside in this case, then we have our entry signal and we can enter long market here, put the stop loss below, and at least have a take profit, at least the start of the impulse or an interesting level from the past. So let us check the break-in structures. So the setup with the 2 stars, let us check them in long and short scenario. So in the first case, or in the first example, we have lower closes, lower closes, lower closes, lower, lower, higher, higher close. So we can buy or draw our first support line over here. And we can see with less than 2 closes, we have broken this. So we would now, because we have a B shape, with this close, we have a breakout below the support lines, we have a break of the support, but we also have a resistance line over here. So we can check for short trades, either continuation short here, and then put our stop loss above here, or we can wait for a pullback and then enter short. Both are the options. Both of them failed in this example. So we break back into our range. So there we have our resistance line. We break back into our range. So we have a stop, but that's okay. And then we can check for a break in. So we could think about entering long at the break in, because we had a B setup, we broke out, we broke back in. So we have a break in example, like we had an example, and we can think about entering market long here. But this is a very aggressive one, and our risk to reward is kind of bad because our stop loss would be below here. So our stop is kind of big, and our first take profit would be there. Let's make this green. Our first take profit would be there. So the risk to reward is not that good. So we can think about waiting for a pullback. So the sign is we broke out of this balance. We broke out, we broke back in, we don't need to enter market. We can wait for a retest of the lower side of the range. So we can wait for a retest of the lower range. The retest would be here, and put our stop loss below there. So our risk to reward is way better. And we would continue in this direction. As I said, take profit start of the impulse if there are aggressive moves like here. So you have a very likely that you have strong market players here. Then you can also look for interesting areas of the past and at the rest of the trade run. Furthermore, there are pattern breakouts. So if you have ranges, you just have basic breakout patterns. And in those breakout patterns, there are, let us create some ranges. So we have 2 lower closes. We have 1 lower close, 2 lower closes. So our highest close is this one. This is our resistance line. It's not that one because it is an open. We have a resistance over there. Then we have 1 higher close, another lower close. Then we have 1 higher close, 2 higher closes. So this can be our first range. So this in between here is our first range that we focus on. Depending on how the market is, but we can just think about, we have a bullish market structure here, and then we have a breakout. We can try or think about scaling in there aggressively, again with a market order, but the breakout candle is kind of big. So we can scale in there, or we can wait for a retest on the area. And quick question, where is our stop loss? Our stop loss would be below the breakout candle. The breakout failed. Either we entered market, but unlikely that we enter market because the breakout is very big. On the pullback, if we got filled, we both ways or in both options got stopped out. But that is no problem. So let us continue. We continue with the break in. So a P shape, we have no fake out to the downside, but we have a breakout to the upside. So it was a very aggressive scaling into a trend, but the trend does not continue. So we can think about scaling also back. As soon as this close happens, we are accepting this range again. So we can think about trading the break in. So we can extend our resistance line and try to scale in short on the upside of the range. So we could look for a sell limit here. We doesn't reach that point, but it is no problem because we also have other options to scale in short. So we can also extend our resistance line. So in this case, we have a first breakout to the downside, but we also have a value shift. So we break out and then we break in again. But the setup is not as beautiful anymore because if we would not have this part and we only break out and then break in, very nice scenario to continue for longs. But it is not the case because we already tried the breakout to the upside before, so we are not looking for the long setup in this case. We more or less have a range extension because we close outside, we close back in, but we have lower closes, and at this point we have two upper closes, so we have another support line and we build another range. We have a higher close, we have a higher close, lower close, higher close, one lower close, another lower close. We have another range built in here, and that range is lower than the previous one. So this one is the second range, this one is the first range. So we have kind of a value shift. People accept trading at lower prices. Sadly, we did not get an entry here, but it's okay. So in this case, we start to form a very passive, it's not really beautiful, but kind of a passive B shape. So at first we had the P shape failed, we got stopped out, we did not get our short entry, but we are forming a B shape. We can trade this breakout here. Again, entry here would be too aggressive, but we can look to scale in for shorts over here. We don't get a really good retest. But if there is a retest, where do we put our stop? We put it above a high volume area, or at least the middle of that range. If we want a higher hit rate but less risk reward, we put it above the range. And now I deleted everything. Let me create. So we had a first range here. We now have a second range here. We have a breakout, we have a retest. And we have a third range because we have one higher close, two higher closes. So we have our first support line. And then we have two lower closes and we have a price trend continuation. So we have two higher closes, lower close, second lower close. So this is our third range. Again, this is the resistance because this is the closing price, this is an opening price. That's why we don't take this into account. So now we have one range that is at this point. We have another range that is at this point. And this looks like a very good trend shift because yes, we tried to trade the trend continuation here, but it failed. No worries. Tried to scale in short, didn't get the short, no worries. We could have gotten a trade maybe here at the retest. And now we have the third range that is lower. If we have been in an uptrend, this is a good indication that the trend is weakening because value and accepted trading value is lower and lower and lower. So we can look for shorts. So now at the third lower trading style, it can be very interesting to scale in at the breakout, put the stop loss above the high, and then look for the start of the impulse. So where the impulse of the trading was, and try to take that as take profit and let the trade run to the downside. Because very often you have in trend shifts that you have one lower value, you have another lower value, you have a third lower value, and the breakout of the third one, then there's a push. You'll see that pattern very often if you stare some time at the charts, and it's the thing we trade. So, hope you understand the counting of closing prices in Japanese candlesticks and the setups for that. I now ask you to proceed to the proficiency test for Volume Profile Mastery 400 and check if you understood everything and learned it correctly. So, let us proceed after you check this with the next series, or you give this series a rewatch.